Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
So in today's episode, we're blessed to have Quincy Brown. He's based in Cincinnati with 29 years at FEG Investment Advisors. He currently leads their values-aligned investment platform with a focus on responsive investing, faith-based, and diversity-aligned strategies. And he's going to share with us today how FEG integrates those values and ESG principles into manager selection and portfolio construction. Also, he's going to share the firm's longstanding commitment to diverse and emerging managers, and how FEG approaches pushback and maintains conviction in today's macro climate. So with that, we welcome Quincy Brown.
Thank you, Ernest. Appreciate it.
Quincy, I always like to start off before we start jumping into what exactly the allocator does and their day-to-day and their thoughts on the market. We like to jump into talk about the person. And so, Quincy, could you tell us a little bit of just like how your career path has led you to this point?
So it's interesting because a lot of times when I talk about how I started, I'll oftentimes get a wow or you can't be serious, you don't look that old. But as you mentioned, I've been here at FEG for 29 years, and it's essentially, you can all call it my entire career has been at FEG. So my background, though, I went to the Ohio State University. That also evokes some response in a lot of instances. And I was part of their student investment team, and that really was one of the next steps from what I thought my career was going to be. I wanted to be on one of the coasts, kind of like what you are today. And however, family circumstances anchored me to this area. And so finding something that fit the profile of that investment background here in the Midwest was not as straightforward. But then, just like we're having this conversation today about allocators, the consulting industry was foreign to me, and it still is to a lot of people not in this space. And finding and discovering the idea that you're really not selling anything other than your intellectual capital was appealing in the investment side. And so back in 1996, joined FEG as one of their first analysts, and springboard my career to where we are today.
See that we have it on tape. You got me to say wow. And even if you looked at and people see on the intro when I was going through that, I kind of had to step back. I was like, wait, what? It's like, am I talking to Benjamin Buttons? But good genes. For someone, you're looking for, you were anchored, for family, and you found something that matched, but you really found something that matched because you've been there for almost 3 decades. What has it been about the company, the role, and the opportunity that's kept you there?
Being employee number 20-something, I can't even remember at this point now, there was that definite entrepreneurial spirit. We're doing things, again, that whatever we did impacted clients in terms of being on the ground floor of the industry and those relationships. And even from the heritage of the firm's founding, our principal founders came from pension consulting. And they were very much so involved in their community and recognized there was a gap in how they were being served. And so the energy of that entrepreneurial spirit, being on the ground floor of that process and being connected to those organizations that really needed you really appeals. And we do have a very trusting atmosphere here at FEG. Very good people who work hard, and so that angle is really the anchor, if you will, that kept me here at FEG for this long.
Now, could you tell us, the audience, about FEG and its history, what it does? And I saw, in the research in our prep call, it's a very interesting group that they serve as well.
Sure. So we were founded in 1988, as I mentioned. Our original principals came from Prescott Ball and Turbin, was pension consulting, and they also were associated with nonprofit groups themselves and recognized that those organizations weren't being served. And so they spun out from that organization and founded FEG at that time. And so what we are beginnings were a non-discretionary consulting firm, and today largely nonprofits. About 90% of our clients are nonprofit in nature. So that includes higher ed, colleges and universities, community foundations, healthcare systems, private family offices and foundations, religious or faith-based organizations, as well as charitable organizations. And so that service, back in 2003, we were one of the first consulting firms to step into the discretionary space or outsource CIO. Mm-hmm. And that was from a recommendation from a client who essentially asked us, what would you do if we just let you take the reins? And so that was the impetus of that section of our firm. And then from there, we continue to do both non-discretionary and discretionary services as well as research services, where we provide back office research for registered investment advisors, banks, insurance, and private family offices.
Those groups are going through a lot of different challenges over the last, definitely the last 30 years. How have you all been able to stay in tune to what their needs are, and then also still wear that OCIO hat where you need to look, 2 decades ahead on providing them not only what they need today, but what they'll need, their organizations will need for the next couple of decades?
I often state that we're in the trust business because we're dealing with money, right?
Yeah.
And most people have some sensitivities about money, but even more so for organizations. And it's given the large amount of our clients are nonprofits, there's heartstrings attached to that as well. So building that trust begins with understanding those organizations, what their missions and objectives are. And so that gives you insight and maybe see around the bend to understand what are their sensitivities, how should we be positioned, how do we best navigate or structure their investment strategy in order for them to sustain those organizations over time. And so we have very long tenured client relationships, and I think that's from the foundation of building trust. And then that gives you a little bit of foresight into how to navigate various markets and make sure everyone's on the same plane.
What are typically the profiles of these organizations? Like how big, small are they typically, the nonprofits and faith-based organizations?
Yeah, we work with a large range in that standpoint, upwards of close to 10 billion in size down to 10 million. So it is a broad spectrum and different classifications. And so you get a lot of different perspectives. You have those that have committees or boards that are very in tune with the investment landscape, and you have those that really don't have a background and just want to support the organization that they have some association with. So it has become a wide spectrum, and you have to manage expectations is probably the best way to serve each one of those organizations in the most meaningful way.
Yeah. You spoke about how we're in the trust business. We're also in the framing business, right? And kind of like, as you mentioned early on in this conversation, is in the investment business, you're selling your ideas and how you think. To that point, saw that you have responsive investing as a terminology. What does that mean to FEG in practice?
So let me take a step back and even go above that. Our values aligned investment team covers responsive investing, as you mentioned, as well as faith-based and diverse manager initiatives. And responsive investing really covers the forum that you could think of as sustainable or even just ESG area. And so the evolution of our strategies in that space really goes back to the primary segments that we serve being largely nonprofit. Those organizations tend to have missions and values that are biased or may lean in that direction. And so from the outset, again, going back to building that trust and understanding those organizations, helped us navigate or structure strategies and find investment solutions that meet their needs and aligns with their missions.
Are you seeing any common themes when you look at those organizations of like, okay, different buckets, whether it's like financial inclusion, environmental, helping those in kind of like that are not in the middle class get into the middle class? Curious on kind of what the themes of values that you're seeing come from those organizations.
Sure, and I think it also stems from the profile of those organizations. So within the faith-based space, for example, you have some that may be more restrictive in terms of what they want to exclude exposure to. But also in that space, there are perhaps more environmental sensibilities across what transpires here on the planet. I think what we're starting to see more of, particularly in the charitable and perhaps private foundation space, is healthcare is an area, real estate sensitivities, affordability, and then also just those areas or communities that are underserved or underrepresented. You see those type of trends within those segments, and that's where we've seen most of the interest. And you mentioned in the venture space, there's been a more acute focus to perhaps leaning into venture and private equity to be more impactful across those categories I just referenced.
I worked at a nonprofit consulting firm. And so you're usually seeing the model of people really using grants to really make their influence within those different areas that you kind of mentioned there, healthcare, environmental, racial justice, whatever it might be. But now I'm starting to see a shift now that I've been a decade plus in venture, these same organizations seeing the importance of going into venture and private equity because emerging technology is having such an influence on culture and those industries. Is this kind of, you think, one of the tailwinds on why venture and private equity has been acutely focused? Is there kind of a reframing of kind of theory of change?
There's kind of a melding happening between the traditional investment portfolio and your PRI, program-related investments, or your MRI, mission-related investments. And those are kind of converging, whether it's from a resource standpoint or a philosophical intention. And then venture is on the ground floor of that. And so you're almost doing double the work, if you will, or double the impact, perhaps, in that you're on the ground floor where people have their hands on the pulse. But at the same time, within the investment program, there's a niche, if you will, that meets an objective or values segment to what the organization may be trying to do. And so that's where you see a little bit more of that mentality or kind of mindset moving in that direction. The momentum's happening. Now, I can't say it's a tidal wave, but you can see it burgeoning in various organizations about their thinking in the space.
Now we're going to take a quick break to speak with our sponsor.
Hi, I'm Jeremy Rich, Senior Vice President on the Catalyst 2045 team at SVB, a division of First Citizens Bank. For over 4 decades, SVB has been the financial partner of choice for the innovation economy. We understand the unique needs of founders, fund managers, and investors building in fast-moving, high-growth sectors because we've been there every step of the way. Through the Catalyst 2045 team, we work closely with venture firms and institutional investors to help them grow their platforms, raise capital more efficiently, and unlock new opportunities across the venture landscape. When you work with SVB, you're not just getting a bank. You're gaining a partner with deep sector knowledge, extensive networks, and tools to help you scale. We're proud to support Swimming with Allocators and the people shaping the future of venture.
And now back to our LP interview.
Since you've mentioned kind of the diverse and emerging manager being kind of also focused as well, how does your team identify and assess, get access to these diverse and emerging managers in your pipeline?
So let me take a step back and also reference that we define diverse a little bit differently than a lot of organizations. Obviously, ownership is probably the paramount, but we're thinking, at least we believe we're thinking, that we're looking forward into the future. How do we make change perhaps 5, 10, 20 years from now? And so beyond looking at ownership, we also look at leadership of the firm as well as portfolio management of the firm. And so in that realm, we think that it builds towards the future, because ultimately firms are often formed from a portfolio manager that left their original organization and branched out on their own. If we're behind a portfolio manager that we identify that falls into that category, it becomes a springboard perhaps to that firm forming in the future. Similarly, so from the leadership standpoint, if you have a diverse person in leadership, more often than not, the rest of the firm is more diverse and encompassing of a lot of different parties and thinkers. And so that's the outset of how we look at diversity a little bit differently, not only thinking about it today, but thinking about it in the future. But ultimately, we do it in pretty much the same avenues that we're doing any other investment managers. We're going to the conferences where a lot of managers may be represented. We're using databases as well as we're sending out questionnaires to managers to try to understand who and what they are and what their principles may be. And so that helps inform and expand the universe. But again, going out to conferences, meeting people, having conversations like today, you end up making those connections and associations that develop into coming into the process of how we evaluate investment managers.
You mentioned that you also define it by ownership. Is there a certain target you look for ownership?
Well, yeah, there's two elements we look for, and this is across the board. So for on the discretionary side, we're looking at a 50% threshold for ownership, a 50% threshold for leadership, or a 50% threshold for portfolio management. So those with their hands on the steering wheel. On the non-discretionary side, we come down to about 40% to kind of make sure that we have a starting point for those organizations who may be first stepping in that, but we'll meet a client wherever they perceive their threshold to be, and provide education around how they're pursuing various policies or engaging on the topic.
I always like to ask when we have someone is like, from a consultant or OCIO perspective, are there any quirks, challenges or opportunities that emerging managers can take advantage of to get connected to organizations like yourself?
I try to have these conversations with diverse and emerging managers on that exact question. As much as obviously the attention is going to be growing their organization, building assets, it helps those individuals to understand who they're going to be serving. So, for example, there's oftentimes a distinction between the board, the staff, and the investment committee. And the more you can observe that those three levels of the organization are tied together, that will help inform you on how you can approach them. The other thing is understanding how you might fit in their investment program. So then in those two realms, you can speak their language, and they can learn to trust you, going back to that, we're in the trust business, sooner. And those relationships can develop a little bit faster.
Could you talk a little bit about how the research team plays in developing the relationship and trust, and how they make their recommendations?
Sure. So we have close to a 30-person dedicated research team. It's a kind of career path here at FEG, and they're doing many of the same things I mentioned. They're going out to conferences. They're reading all the latest information to make the connections, and they're kind of the gatekeepers. And so within my group, we help make those introductions to help expand the universe of the investment managers they may be pursuing, but they're the gatekeeper in terms of setting up or doing those introductory meetings, a lot of due diligence that goes into that process. And then they produce research reports that are then presented to our investment committee for potential approval as a recommended manager on our approved list, if you will. And then internally, we're using that as the basis for how we're making recommendations to our clients in terms of fulfilling their investment program.
Could you talk about the diligence process and the things that you look for those who might have a track record versus those who don't have your traditional sense of track record?
I think you're maybe referring to oftentimes with emerging managers, the size of the organization or the assets they have under management, the years of founding are some of the things. And so in terms of looking at emerging and diverse managers, we take those into consideration. And oftentimes it's also about building relationships. Mm-hmm. So you may not, if we're talking about venture or private equity, you may not get into the first fund with that manager, but perhaps you get into the second. And that also aligns with our philosophy, if you will. Oftentimes our view is that the best performance from, particularly on the private capital side, comes from funds 2 to probably 6. And in fact, we also have some principles that, even though size is getting outsized in the markets over the last several years, we tend to gravitate towards funds that are less than $1 billion. So it ends up being parallel sweet spots for emerging managers to some degree. But coming back to your point, we're aware and sensitive to the fact that emerging managers have those hurdles related to asset size and track record. And so sometimes it just becomes about building that relationship. So when they turn that corner, it's less of a glide path, or that runway is shorter for us recommending them to some of our institutional relationships.
That's great data on the funds that perform the best. Now within those 2 to 6, do you have trend lines of, it's usually 2 and 3 versus kind of 4, 5, and 6? Do you have any data around that?
No, I think it really comes down to where the organizations are, perhaps from a business standpoint. If they've been able to build up their infrastructure earlier on versus doing that simultaneously through that 2 to 6 window, that oftentimes may be the distraction that may have some deviations in performance. But ultimately, we think the energy, the focus, the hunger, all the things that you're trying to build a good business around tends to happen in that realm. Now, obviously, it's not always the case, but at the same time, we're watching what you're doing from a business and organizational standpoint. Are you able to keep or grow talent?
Yeah.
How's your back office being served, whether that's outsourced or building it internally? All those different things kind of tell us about our organization, about managers, and how they think about not only running their business, but how they're investing. I think some of those things can run parallel and be attractive or warts that we want to monitor.
Yeah. I have to ask, how do you deal with kind of the, from outside perspective, at odds of performance versus kind of the mission alignment? Where do each of those come within kind of your decision or diligence process?
So from the outset, when the managers that we're looking for and looking at, we believe that you can do both. Mm-hmm. You can outperform and serve your mission. Now, there are some investments, as I mentioned, we're talking about the confluence or merging between traditional investment program and PRI and MRI investments. And some of those are dedicated, where you're willing to forego maybe financial benefits to align yourself with your mission. But the strategy under our values aligned investment team is to be able to do both, to align with your mission and values and produce performance. And so we're acutely aware and focused. We apply the same tenets of how we evaluate managers with those that may be more mission or value aligned to focus. So there's no deviation in terms of the due diligence or threshold that we're pursuing.
Okay. And because you're helping with kind of the entire portfolio, have you seen the kind of missions focus align with certain asset classes versus others, right? Because you're looking at venture growth and buyout and other stuff as well. have you seen kind of like your nonprofits when they're onboarding or when you're having catch-up calls with them push for one asset class versus the other?
No, we're typically leading the process on the asset allocation. So that's paramount at the beginning of the relationship, is developing that strategy through the investment policy and the asset allocation. I will say it's more so where the opportunities most lie in terms of aligning mission. You're going to see that mostly on the equity side. And we think of global equity, both public and private. You'll see it a little bit on the fixed income side, but less so. And that's more so lending, where you see a lot of the emphasis. But where we're starting to see and have seen over the last few years is more focus in the real asset space. And again, that goes back to real estate. And then you think about energy transition. Those are in areas that we oftentimes see more viable investments that we can present. But the vast majority is going to be on the public or private side of the equity market. But you're seeing other areas of focus start to poke their way through and gain a lot more energy.
Yeah. You know, as we do this interview, with respects to kind of ideas of mission-based investing, for diversity, ESG, there's been kind of a macro kind of like backlash against a lot of those things right now. So I was curious, from FEG's perspective, have you seen a client base that is a little bit more cautious, a little bit more frustrated? Just curious on kind of how that is. So first, starting with that point of how the client base is doing with all of these tidal waves coming at them.
Yeah, so it probably started 2 years ago, perhaps, on the ESG side. That really garnered a lot of attention. And so perhaps the acronym has changed or they've relabeled it. We really haven't seen any tail off to a material degree, maybe plateauing as people try to recalibrate how they're focused in that area. And similarly, so we're now seeing the same thing as it relates to the diverse, and obviously DEI has become the same kind of red flag as ESG was. And you're seeing the same type of things occur where it's just perhaps a shifting or rebranding. Now, it's going to be more distinctive in different segments. Colleges and universities, probably about a year to 18 months ago, had already begun to rebrand their programs in some ways. And now you're seeing that spread out in different segments that may be doing the same. But the energy, for the most part, appears at this point to be the same in terms of being committed to those spaces. It's just, it may be called something different, but they're doing the same things. And it, again, goes back to where are the institutions aligned in terms of that board, staff, and investment committee alignment. If those things are still stable and strong and they're still on the same page, you're seeing the same type of action in terms of what they're trying to pursue. If there's some deviation from vision or views amongst those three, then you see some pause or pullback, if you will, in terms of intentionality in some of those mission spaces.
Is there anything that the organization has learned from the ESG experience to now with the DEI experience that you can employ?
I think, again, they run parallel in terms of how people are operating. I think, again, that nomenclature people are pivoting towards, and perhaps it's not ESG, it may be more sustainable. And as I mentioned, we call those that area responsive investing.
Yeah.
I think similarly, so you're seeing, as I mentioned, diverse manager programs are coming under the umbrella of emerging manager.
Yeah.
And so those are the things that are more significantly focused. And the other thing I would say that maybe separates the two is that on the diverse manager side, you're maybe peeling back from quotas per se, if you had them. It's more so looking for growth in those areas, or it's more distinctive on the, like I mentioned before, the emerging manager umbrella. And so those are the things that I think are common in both areas as it relates to the philosophies or strategies, and the investment managers themselves are doing the same things.
Yeah.
So whether you're talking from the LP or client side, the managers have migrated or shifted that kind of nomenclature in both of those areas.
Yeah. Switching gears, is there one trend in venture or private markets that excites you right now?
That's an excellent question that excites me right now. I would say the thing that excites me right now is how technology is shifting a lot of industries.
Yeah.
And thus the opportunity set is that much broader. So ordinarily, from a historical standpoint, a lot of the venture was in tech, biotech, fin. And so now you're seeing, because of technology in general, the opportunity to go in different spaces, whether that's in consumer, manufacturing, food, things of that nature. And then obviously pivoting towards, as we talked about before, energy transition. So
Yes.
I think as we are strategists, if you will, on behalf of our clients, we're always looking for the next thing. And so I think technology has enabled the next thing to be in more traditional spaces. And so you don't have to necessarily have spent 20 years in a space to understand what's happening. That technology, creative thinking, insight in different ways, and perhaps being disruptors has enabled the opportunity to look in some new areas. And I think that's only going to add value in terms of investment returns on behalf of our relationships.
I think it's so true. It's something that I'm excited about as well, where the ubiquitousness of technology is seeping through every industry. And it's going to be, in a world of more automation with AI and consolidation, I think it's going to be important for all the different worlds to bridge together, right? We can have more resilient nonprofits, more resilient manufacturing companies, more resilient, name whatever industry, if we actually incorporate the human knowledge and human co-creators who've been in those industries for a long time with the technology that's actually going to take on a lot of the things that computers do much better, of like being able to just keep working and take a lot of information. But then humans will be able to do the things that they do best, is empathy, collaboration, creativity. So I think that's the ideal, in my opinion, point of view. And so I like seeing all the worlds come together. If we all stay in silos, then I think the less appealing kind of situation happens, where we just have a lot of automation that steamrolls, and then we have we'll definitely have to have UBI in the entire society.
Yeah, I think the last characteristic you referenced, the creativity. I think technology enables the creativity to hit the ground sooner, and that will be beneficial in many avenues towards creating new industries and, quite frankly, returns, obviously, what we're talking about.
Yeah. What's some advice that you would give emerging managers who want to work with consultants like FEG?
Yeah, it kind of goes back to a point I mentioned before about not only are you as a investor trying to grow your business, but who do you really want to partner with? I think if we think about the history of some of the best or most well thought of investment professionals, it goes back to trust again. So I'm building an investment business. I want to find a partner who believes in what I'm doing. And so understanding the profile of who you want your investors to be. Now, again, I know it's that sense of urgency of gathering assets and building your business, but the sooner you can identify the best type of profile that fits what you're doing, there's a better connection of resiliency as you go through perhaps bumps in the road, because you're unified in your belief in, quite frankly, one another. And so understanding the profile of who your going to pursue, whether that's colleges and universities, whether that's community foundations, or whether that's private family offices, what the anchor of your investor profile is going to be. I think that is one thing I don't think a lot of early investors really think about or pursue.
Sure. And any point of advice you would love to give to other allocators, whether it be foundations, nonprofits that are interested in building a more values aligned endowment or book?
Well, the first thing I'd say is you can do both. I think oftentimes there's a sensibility that they have to be distinct buckets. Mm-hmm. And I think given our track record and the relationships we've had for a long time, speaks to the fact that it can both be done. And then understanding that you're focused on a long range view. Separating your human instincts and avoidance of pain to recognize that you have to step out to make returns. And so realizing that you can do both, that you need to have a long range vision and be committed to that. Obviously, you want to revisit and make sure you're headed in the right direction. But if those two things are succinct, I think you'll be successful and committed to making it towards meeting your objectives for that organization.
Okay. Well, Quincy, really appreciate you sharing your story, sharing the story at FEG. And if people want to get connected to you or your organization, how should they do it?
FEG.com is a way to check our website. You can reach out to me directly on LinkedIn. I'm out there. I'm not the most prolific poster, but I do check on it periodically, so that be a way to connect. And I try to venture out to various conferences, but those are areas or ways you can pursue FEG as well as myself.
Well, thanks, Quincy. Thanks for being on Swimming with Allocators.
Appreciate it. Thanks for having me.
See you later, allocator.
After Portfolio Tile, Investing with a Smile.